In 2026, a new fear is spreading across financial markets, political institutions, and ordinary households around the world. It is not a war, not a pandemic, not a natural disaster. It is something far more subtle, yet potentially more powerful. The question being whispered in trading rooms, debated in parliaments, and searched millions of times online is this: is the United States dollar losing its dominance? And is the world slowly turning against the American economy? For decades, the US dollar has stood as the backbone of the global financial system. It has been the world's primary reserve currency, the default medium for international trade, and the safe haven during times of crisis. Oil is priced in dollars. Global commodities are traded in dollars. Central banks store dollars as protection against instability. The strength of the American currency has not only symbolized economic power but geopolitical influence. But in 2026, the foundation appears to be shaking. The first warning signs did not appear overnight. They built gradually over years of rising national debt, aggressive money printing, geopolitical tensions, and shifting alliances. After the pandemic-era stimulus packages, the United States expanded its money supply at historic levels. Trillions of dollars entered the economy in a short period of time. While this prevented immediate collapse, it also created long-term inflationary pressure. Prices rose across food, energy, housing, and services. Inflation became more than a temporary spike. It became a structural concern. As inflation climbed, the Federal Reserve responded with aggressive interest rate hikes. Borrowing costs increased. Mortgage rates surged. Businesses faced tighter credit conditions. Stock markets experienced volatility. The dollar initially strengthened because higher interest rates attracted foreign capital seeking better returns. But this strength masked deeper vulnerabilities. Behind the scenes, global powers were reconsidering their dependence on the US dollar. Countries such as China and Russia began accelerating trade agreements in alternative currencies. The BRICS alliance expanded discussions about creating new payment systems independent of Western financial institutions. The phrase dollarization moved from academic journals into EAM headlines. Why would nations want to reduce reliance on the dollar? One major reason is sanctions power. The United States has used its control of the global financial system as a geopolitical tool. By restricting access to dollar clearing systems, Washington can impose severe economic pressure on rival states. While effective, this strategy has also motivated targeted countries to seek alternatives. No nation wants to remain vulnerable to financial isolation. Energy markets provide a powerful example. For decades, oil has been traded primarily in US dollars, creating consistent global demand for the currency. But in recent years, some oil exporting countries have agreed to accept payments in other currencies, including the Chinese yuan. Though still limited in scale, these agreements represent symbolic cracks in the system that once seemed unbreakable. At the same time, America's national debt has climbed to unprecedented levels. Government spending continues to outpace revenue. Debt servicing costs are rising as interest rates remain elevated. Investors are beginning to question sustainability. While the United States has historically been viewed as the safest borrower in the world, concerns about long-term fiscal discipline are growing louder. If confidence weakens, even slightly, the impact could be enormous. The dollar's dominance depends not only on economic size but trust. Trust that the US will maintain political stability. Trust that inflation will remain controlled. Trust that the legal system will protect investors. Trust that treasury bonds will remain the safest asset available. Confidence is powerful but fragile. Global central banks have slowly diversified reserves. Gold purchases have increased significantly in recent years. Some emerging economies are holding a smaller percentage of their reserves in dollars compared to previous decades. This shift is gradual, not dramatic, but trends matter in finance. Critics argue that talk of dollar collapse is exaggerated. They point out that no other currency currently matches the dollar's liquidity, stability, and global acceptance. The euro faces structural political challenges. The Chinese yuan remains tightly controlled by Beijing, limiting full convertibility. Cryptocurrencies are volatile and lack universal regulation. In times of crisis, investors still rush toward the US dollar, not away from it. However, supporters of the de-dollarization theory argue that Transitions in global power do not happen overnight. They unfold slowly then suddenly. The British pound once dominated global trade before losing its status to the dollar in the 20th century. Economic history shows that reserve currencies can change when underlying economic leadership shifts. Another factor influencing 2026 fears is political polarization within the United States itself. Intense partisan battles over budgets, debt ceilings, and fiscal priorities create uncertainty. Government shutdown threats and repeated debt ceiling standoffs send worrying signals to international investors. Even if resolved, each episode chips away at the image of absolute reliability. Domestic economic pressures are also contributing to anxiety. The housing market has cooled under high interest rates. Consumer debt levels are rising. Credit card balances have reached record highs. Small businesses report tighter margins. While unemployment remains relatively stable, certain industries are facing layoffs, particularly in technology and manufacturing sectors affected by automation and global competition. If economic growth slows significantly, while debt continues rising, markets could interpret this as structural weakness. A weaker growth outlook reduces foreign investment appetite. Lower capital inflows can weaken currency strength, yet the situation is not purely negative. The United States still possesses enormous advantages. It has the world's largest economy, deep capital markets, technological innovation leadership, and military influence. American Treasury bonds remain among the most liquid financial instruments globally. The rule of law and transparent institutions continue to attract investors seeking safety. The debate in 2026 is not whether the dollar will disappear tomorrow. It is whether gradual erosion of dominance has begun and whether the world is preparing for a multipolar financial system. If the dollar were to weaken significantly, the impact would reach ordinary Americans immediately. Imported goods would become more expensive. Inflation could accelerate again. Interest rates might rise further to defend the currency. Global purchasing power of U.S. consumers would decline. Travel abroad would cost more. On the global stage, emerging markets holding large dollar-denominated debt could experience instability. A rapid shift away from the dollar could create turbulence in bond markets, commodity pricing, and cross-border payments. Financial systems, built over decades around dollar settlement, would require restructuring. Some analysts predict not collapse but fragmentation. Instead of one dominant currency, the world may operate with multiple regional financial centers. The dollar, euro, yuan, and potentially digital currencies could coexist in a more balanced structure. This would reduce unilateral power but increase complexity. Technology also plays a critical role. Digital payment platforms, central bank digital currencies, and blockchain-based systems are evolving rapidly. China's digital yuan experiment demonstrates how technology can reshape cross-border transactions. If digital alternatives reduce dependence on dollar-based settlement networks, the structural demand for U.S. currency could gradually decline. Public perception inside America is equally important. When citizens hear phrases like dollar collapse or economic decline, confidence in markets can shift quickly. Consumer spending is heavily influenced by sentiment. If households begin hoarding cash, reducing investment, and cutting spending, economic slowdown can become self-fulfilling. Media narratives amplify these concerns. Headlines about BRICS currency alliances or massive gold purchases by foreign governments generate fear even if underlying data remains gradual. In financial markets, perception often moves faster than reality. Still, the strongest argument against immediate collapse is simple inertia. The global financial system is deeply interconnected with dollar-denominated assets. Contracts, trade agreements, debt instruments, and commodity markets are structured around it. Replacing this framework would require enormous coordination and trust among rival powers that historically compete with one another. The real question for 2026 may not be whether the world is turning against the American economy, but whether the world is diversifying away from overdependence. Diversification does not equal destruction, but it does signal change. Change in global finance rarely announces itself loudly. It begins quietly through bilateral agreements, reserve adjustments, and experimental payment systems. Years later, analysts look back and identify the turning point. Is 2026 that turning point? That depends on several key variables, including U.S. fiscal reform, geopolitical stability, technological innovation, and global growth trends. If the United States demonstrates long-term debt management, strengthens domestic production, and maintains investor trust, the dollar could remain dominant for decades. If polarization deepens and fiscal imbalances widen, the erosion could accelerate. For now, markets remain watchful rather than panicked. The dollar still commands influence, but questions once considered unthinkable are now openly discussed.